Good Thursday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, all the way from Philly, Dimitri Pargamonic. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with a disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker-dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
All right. What's going on in the pre-market this morning?
Yep. Let me share my screen. And what we'll do today, take a look, excuse me. We'll take a look at the pre-market report, see what's moving in pre-market hours. We have a lot of questions actually coming in this week through emails. A couple we had through the chat that I want to get to. I know we had another one yesterday regarding skew. We asked to go back to that question. Today we'll do the question we had a couple of days ago, and it was regarding looking at a pre-earnings straddle. All right, so this is a particular type of alert we do have, and what it's doing is looking at a straddle purchase opportunity pre-earnings, and it looks for a certain type of criteria that make it a good opportunity. All right, and that's what we'll go through. Why is it a good opportunity? What makes this a potential good opportunity? What the logic is behind it? How do we analyze it? Okay, so we'll do that today because I believe that was one of the questions we got on the chat a couple days ago. Will?
Yeah, that was from a newer chameleon who joined in. The other Robert was asking about looking at long strangles and straddles going into earnings.
Right, and that's what we'll do. We'll look at the criteria, and I think the point of the exercise is to start to think in a different way of like, how do you identify opportunities? Why this could be not only why this could be an opportunity, but how do you apply it to your trading overall? Like, how do I think this way to look for other opportunities that have similar thinking? Okay, and when we go over this, what I'll tell you is that this thinking is similar to you guys ever see The Big Short? The movie The Big Short, and there are people betting on the mortgage that the mortgage industry would collapse, and they were shorting basically the housing market through these mortgage securities. And in the movie, you had different players doing it, and one of them were these two guys that were really young, like college students, and they were looking for a certain type of opportunity that they used in the options market, in the derivatives market, that made them really wealthy up to the point before they even made that big bet or the Big Short. So this will be similar thinking to the strategies that they were using. And I think, in there were millions of dollars, even prior to putting on this Big Short, and they were doing it basically from their home. So it'll be similar thinking, and I'll show you guys what that pre-earnings straddle alert would look like. Okay. So before we get to that, let's first look at the pre-market report, see what's trending in pre-market hours. If you guys do have questions, I want to go over, we'll have to push them back a little bit because I do have a lot of questions now popping in, through email as well, that I wanted to get to, that I think would be interesting to everybody. And I think Lawrence said he wants to come on the show and ask questions about skew. So let's see if we could do that one tomorrow if he's available.
All right.
So let's start the pre-market report. And these are stocks trading in pre-market hours. We have our most active stocks, our biggest percentage gainers, and biggest percentage decliners. I'm coming down here and I see 35 stocks made our percentage gainers list and 55 on the decliners. From this perspective, we look like we're set up for more bearish bias at the open. I'm going to filter this list out. Let me refresh my screen actually, because I had this up for a while. I'm going to filter out the list below for stocks that are only part of the S&P 500. We want to take out small cap stocks, ETFs, leverage products. Let's remove all those, see what's going on in the S&P 500. And to do that, I'm going to use this filter here in ETF. When I drop it down, I get a list of ETFs. The top one is SPY, which is the S&P 500 ETF. When you click on it, the list below will get filtered by stocks that are holdings in SPY, which are the S&P 500 constituents. And we see here today, 0 made our percentage gainers list, 24 in the decliners. That also indicates bearish bias at the open. All right. If we don't have any questions on this report, I'll just move on to the question about the pre-earnings strategy.
Yeah.
Okay. Now, I don't have an opportunity right now popping up that I could show you, because we're still kind of early in the earnings season, and certain conditions have to hit for that alert to come up. But what I'll do is I'll kind of show you what the setup would look like if those conditions hit. So we're going to go over it and just pretend that the conditions are hitting, just so we could go through an example of what it would look like. Okay.
Yeah, and the start of earnings season usually revolves around I say usually, right now revolves around the banks. So they start to talk about the earnings season and the start of earnings season when Goldman Sachs, JP Morgan, Citigroup, right, they start announcing their earnings.
Right. All right. So right. And so right now, it's pretty light. The calendar is pretty light. I'm going to go here for full report, and based on these parameters I've set, for stocks over $25, average option volume 2,000 contracts per day. There are only 3 right now that hit this criteria. So I'm just going to loosen this up just to get more companies in there. Let's say 1,000, average option volume 1,000. Get a couple more here. So I got CALM, December 28th. After the market, they're expected to report earnings. And right now, the straddle is priced at 8.2%. Okay. I'll just take this as an example, and we'll see if the alert, what would need to happen for this alert to hit. But the important part about it is that you understand kind of what the logic is behind it. So you could just start applying, maybe similar logic or parts of that logic to other places if it makes sense to you. Okay. It's not everybody's cup of tea, but if it makes sense to you. And really quickly, what a straddle is that if you're looking at a at the money option, a call and a put. So you're buying a call and you're buying a put, which is a bet that the stock will move by enough of a percentage, right, by expiration to cover both the price of the call and the price of the put. All right. And so what are we looking for this type of alert? I'm going to go to CALM. Let's just go to CALM. And we want to see that before, let me see, I know I'm moving it around, but I have to explain this. So here's what we see, that CALM reports earnings December 28th. And right now the straddle is priced 8.2%, meaning that here's the price of the straddle, which is 8.2% of the stock price. Okay, so we're looking at 8.2% move. Now, this particular alert does not look at to hold it on earnings. So the idea here is that, is the straddle priced at favorably to hold it between now, because now it's December 22nd, and the day before the earnings, December 28th? Is it cheap enough, right, that it presents an opportunity for that time window? All right, so not the earnings, but the window between now and you're getting out of it the day before earnings. Okay, and we look at it from the following perspective, that if it's priced low, our assumption is the following, that the options will hold their value, because typically as we get closer to earnings, more volume comes in, and they may not decay. They may even go up in price, right? So if the straddle right now is priced low enough that we think, even if the stock does not move, let's say between today and December 28th, even if the stock does not move, we think that these options will not decay, that they will just, be right around here. Either there'll be a small loss or at least a break even, right? That's what we're looking at. Like, we think that we're going to be close to break even, that the straddle that's priced today at 8.2% will be priced at 8.2% day before, meaning that we're going to get what we're looking for is if we could get a free ride for the next, 4 or 5 business days to expiration. I mean, not to expiration, sorry, to the earnings. Okay, and I'll tell you why we need that, why we need the free ride. Because if you could get a free ride, then that's actually adds up to edge. And that's how, by the way, when I was talking about the 2 guys on The Big Short, that's what they're doing, where they're looking at that there are events coming up, that these options are mispriced. They're priced too low, and you're not going to win on all of them. But if you're minimizing or breaking even, then you could potentially have a very big win even before that, because the stock could still move between now and earnings, right? Anything could happen. The market could collapse. You could have news come out. I'll show you an example here. Let's say you did this in Nike. Let me show you guys. Somebody actually brought this up to me. Look what happened in Nike over here. So Nike reported, wait, was it Nike? What just reported earnings? I think it was Nike. Right, so Nike just reported, wait. So it wasn't Nike. There had to be a different one. Somebody brought this up to me.
Under Armour, maybe?
Sorry, it was FedEx. It's FedEx. All right, this happened in FedEx. Sorry, guys. So look what happened. Here was before this earnings, there was an earnings Q1, right? First quarter. Last one was Q2, and the one previous to that was the Q1, scheduled for September 22nd. So you could see September 22nd, they reported earnings. All right. But let's say you bought this straddle thinking, I'm not going to hold it to September 22nd, but maybe it was already priced so cheap that I would hold it and try to get a free ride, right? Remember, I said anything could happen, right? That it's potent. Doesn't have to happen. There's no guarantee, but anything could happen. And here's an example where September 15th, they decided to give a preliminary report, let people know, hey, we're not doing so hot, or there's something that we want to mention before we release the report. And that day was down 21%. So imagine, like, you're getting this straddle that you're maybe breaking. You got such a big event that was even bigger than holding that straddle over the actual earnings. right? Does that make sense to people that why between now and the earnings date, the stocks could still move, right? There's still a potential. And if you think that you're buying it at a cheap enough price that even if it doesn't move, there's a high chance that you're going to keep that it's going to hold that value, then you're kind of getting a very cheap straddle anyway, or you're getting, a free ride, right? And sometimes this will happen, right? Let's come back to, where was I here? CALM. So let's go back to CALM. So then we have to figure out, well, is 8.2%, a good deal? And here we could take a look and we'll say, like, well, what is usually the straddle the day before earnings? And we can see here that here in the last 12 earnings, so going back last 12 earnings, on average, the straddle was pricing in a 9.5% move. So this is letting us know that if it goes back to that average, well, not only are we getting a free ride, but even if nothing happens, there's a chance that the straddle could just increase it by another 1%. But looking at these, you could see that the straddles were priced very high, but the moves were not. The moves were actually pretty low, right? So here, sorry, this was the last one, not 9.5%. Usually it's 8.2%. This was 9.5% was the very last one. So on average, the straddle was pricing in an 8.2% move, which is where we are now, right? So 8.2% move the day before. So if that happens again, what this is saying is that whatever the straddle is priced today, in what is it, like 6 days from now, it'll still be priced right there. But the actual moves were 3.1%. So we might come down, right? We might come down a little bit. And you could see that this straddle is all over the place, like high, low. You could actually, here. This is all the implied moves for the straddles since 2014. So we're right now on the blue line, right? We took the average, you could see that they could come down to, 4%, 4.7%, 5%. So those are things you have to take into consideration. Remember, this didn't hit our criteria. I'm just going over an example of what it would need to do, right? So this would have to be much lower probably to hit our criteria. But the idea there, if you guys understand, is how is the straddle priced pre-earnings with 2 weeks to go, 1 week to go, 3 days to go? Is there a good chance that, it's at 8.2%? Will it hold there? Can it go back up? The average is 7.3 if we go back to 2014. And then what else can we take a look at? So let's say let's say it was priced at 6%. Maybe then it would hit the alert. Let's say 6% would have been low enough, right? Well, we could also take a look and say, how often, hold on a second. Let's say there's a week to go, 1 week to go, and these are percentage moves for 1 week, not including earnings. So the whole week prior to earnings, right? And remember, we're just looking at magnitude of move, not the average move, magnitude. We could see here's one move. It moved up as much as 7.1%. And that's not including earnings, right? Moved 5.9%. So these are telling us that the stock can make some significant moves between, with a week to go, the in-between period. Here, on average, though, it's up or down 2.8%, right? Maximum 7.1, 2.8%. So this would not hit our parameters, right? The parameters obviously to make an opportunity, this would have to be higher probably. This, I think, would have to be in, closer to that 8.2%. And that 8.2%, would have to be below these numbers, 7.3 or close to that. So it didn't hit in CALM, but what I'm doing is going over the logic of, when it hits Y, it presents an opportunity, because the idea there is that you're taking an estimated small risk, hopefully like a break even, maybe a little bit of positive, where you could go up a little bit or down a little bit, right? So there's a chance nothing happens, the straddle could still go up, maybe go down. So you're trying to get close to break even with a potential free ride on a lottery ticket or a big move in between, because anything could happen right in between. Look, between now and this earnings, if the market starts collapsing, everything's going to get pulled down, right? So that's the idea behind the pre-earnings long straddle opportunity. And I think that was the question, that was being asked. If there are no questions, I'll probably just stop right there then.
Yeah, that's good. No need to jump into something else right away.
Yep.
Awesome job, my friend.
All right. Thanks everyone for joining. Everybody stay. Oh, by the way, to use this here, what I'm doing here is if you enter in 8.2% straddle, this is telling us over here, you would calculate 69%. This is helping you out. 69% of the previous straddles were below 8.2%. All right. So let's say, what if the straddle was 6%? Well, 6% would have been a much better deal, because only 34% of the time did the straddle, since 2014, was it priced below 6% the day before earnings. All right. So that's already getting much more attractive if it got down there, right? If you got it at 6%, then that looks pretty good, because there's a good chance that it will appreciate with no stock movement, right? With that there's a decent chance. But there you go, guys. No questions.
Awesome job, Dima. Well, you have a good Thursday, everyone trading. Dima, great job as always. We'll see you tomorrow morning, Friday. Have a great day, buddy.
Thanks, everyone. Stay safe out there.